So maybe you've looked at the performance of international stocks over the last 10 years. And when you think about how big the US economy is, you're maybe starting to think, why do I even own international stocks? Why do people tell me international stocks are part of a, quote, diversified portfolio? If you've ever wondered this, or you're starting to question why international stocks are generally part of a diversified portfolio, this episode's for you. Welcome to episode 10 of the Emerging Wealth Podcast. I'm your host, John Boyd, certified financial planner, founder, and lead wealth advisor at Modern Wealth. That's modern spelt with no vowels wealth. We're a fiduciary fee-only financial planning firm located in Scottsdale, Arizona, but we serve clients all over the country. I am so glad you're here today because we have a good one for you. We're talking all about why people talk about international stocks. Why do all the investing gurus, investing books that are really, really popular bring up international stocks as part of a, quote, diversified portfolio? And the reason why I wanted to do this episode is that I'm going to be very blunt. International stocks, it's been rough, right? It's been a rough ride over the last 10 plus years. And let's think about that for a second. Really, since the end of the 2008 financial crisis. So let's call it 2009, 2010. US stocks have just gone on an absolute tear. And there's a couple of big reasons for that. Number one, the era of money printing began. We were introduced to this ultra low interest rate environment with the Fed's cutting rates to darn near zero for years. And what happens when interest rates are so low? Number one, if you are a saver and you like to have money in a savings account, well, savings accounts, money market funds, short-term treasuries, etc., are all yielding darn near zero. So if you want to get any sort of return on your cash, you are forced to put your money in assets like stocks, real estate, etc. It was dirt cheap to borrow, right? Getting a mortgage is dirt cheap. So it's very easy to put your money in real estate, right? So it's a big reason why during this period of time after the 2008 financial crisis, we saw a major boom with stocks and other assets that are domestically focused. Again, this, having interest rates near zero is a form of stimulus. So fast forward, eventually inflation becomes a problem and the feds have to raise interest rates. And here we are in July of 2023, interest rates, the Fed funds rate is above 5% now. Eventually, that will work its way through the economy and have impacts on assets. But so far, that really hasn't happened yet. And the big reason why that hasn't happened is that now the big buzz is AI mania. There's FOMO in markets. People are pouring money into stocks because they don't want to miss out. And there's AI fever going on. So this has all resulted in a 13, 14-year period of just absolute US dominance for stocks. And as a result, a lot of people are questioning, why the heck do I even own international stocks? Why not just have all my stock exposure be domestic focused or darn near close to it? Well, after today's episode, you'll understand kind of the merits behind why international diversification should be a consideration in your portfolio. So before we dive into some, data around international stocks, I think it's important to understand the behavioral economics of all of this. And so there's really two big points I want to get across here. Number one is that investors are highly impatient. If you look back all the way to the 30s, right? All the way to the 30s, and you fast forward to now, the average holding period for stocks, how long somebody owns an individual stock, for decades, it was closer to 5, 6, sometimes all the way up to 8 years. 8 years. People were holding on to individual stocks. Fast forward to today, depending on which study you look at, the average ownership period for an individual stock is only around 5.5 months now, right? So people put money into a company and get bored of it and want to sell out within 5.5 months. Crazy, right? Imagine your buddy tells you to put money into their business and you only give them 5.5 months to show that they're really worth it, right? I mean, that would be ridiculous, right? But that's effectively what we do when we invest in stocks, whether it's an individual stock, an ETF, etc. And this behavior makes sense, right? I mean, just look at our world that we're in today, all right? You could roll out of bed, pull up your favorite investing app, and buy and sell a stock within the span of 30 seconds. It is that easy to transact in the stock market now. We are also used to convenience, right? If we are trying to load up a web page on the internet and it takes a second or two to upload and it doesn't upload like that, we start to think that something's wrong with our Wi-Fi, right? I mean, again, technology has really led to amazing innovations over the last several decades, but it also has caused us as human beings to become highly impatient. And it also has changed our investing behavior. And that's very, very evident with how long we hold on to stocks. So keep that in the back of your mind, right? That we as investors are very, very impatient. We as a society are just impatient. We want things now. But also consider this. I want to bring up the concept of loss aversion. Now, this is a Nobel Peace Prize winning concept. I did not make this up, but this is one of the pinnacle pieces of behavioral economics. And here's what it is in a nutshell. Let's say that you got a big bonus at the end of the year from your boss, right? So you get a big bonus for doing such a great job this year. You log in to your checking account and you see that big old direct deposit hit. Once you see that money hit your account, you're going to feel pretty good, right? You're going to be excited. You're going to feel a lot of self-worth, right? You're going to feel pretty darn good. And maybe that will last for several hours, maybe to the end of the day. And then tomorrow, life goes on. Don't really think much about that big direct deposit anymore. But let's look at the flip side of that. Let's say that you looked at your investments and your investments dropped by that same amount, right? Whatever that big direct deposit was, $30,000, $40,000, $50,000, whatever it is, that's now a loss in your portfolio. And you log in and you look at all that red on whatever app you're using, you see that big loss and you think, oh my gosh, what's happening? What's going on? How do I fix this? A lot of emotions are going to come. And these emotions are not just going to last a couple hours. You're going to be thinking about this for days now. You might even go on Google and try to find a financial professional to help you out with your portfolio, right? I mean, you are going to be in a position of despair and try to fix this situation. This is the concept of loss aversion. We as human beings feel the pain of losses significantly more than we do gains, right? Pain makes us react differently than wins, right? And you see this in different elements of our lives. It's not just investments, right? I mean, it could be a relationship, right? It could be something like food poisoning, right? I mean, there's a reason why when we get food poisoning, whatever food that we ate that gave us food poisoning, now we just have this disdain and disgust for it because we don't want to get hurt by that again, right? And this is kind of the same concept here, right? If there's something with our investments that causes us a lot of pain and misery, we as human beings are going to try to evolve so that that doesn't happen again. And it may cause us to behave erratically. So now that you kind of understand that, number one, we are impatient and we feel the pain of losses more than we do gains. When we look at the last 10, 14 years, whatever it may be, and we look at how well US stocks are doing, it's hard for us to believe that anything bad could happen to them. But that's exactly what happened to the Japanese stock market in the late 80s. You see, Japan was the second biggest economy in the world in the 80s. Its stock market was booming. Its stock market hit an all-time high in 1989. Japan was an unstoppable force that helped lead international stock markets to outperform its domestic stock markets throughout the 80s, right? During that time, it was very hard to believe anything bad could happen to Japan. There's publications and commentary from that period of time of people believing that Japan was going to overtake the United States in terms of being the largest economy of the world, right? I mean, it's people were thinking that Japan was on fire. And then the bubble popped. Japan's stock market hit an all-time high in 1989 and retracted aggressively. And this retraction just didn't last a couple years and then it bounced back. That retraction is still impacting the Japanese stock market today. The Japanese stock market has not recovered from falling from its all-time high in 1989. It is still not recovered. It's been over 30 years and it has still not recovered. Unbelievable, right? Right? You talk about being impatient. Could you imagine someone who was investing heavily in the Japanese stock market thinking that, oh, well, it'll eventually come back. Just got to give it some time. Just got to ride it out. Well, if that person had that mindset back then, well, they're still waiting for it to come back 30 plus years later. This is really, really important to understand because here in the United States, we have been really spoiled with big sell-offs that have happened recently. Right? When the US stock market sold off aggressively, almost a 40% sell-off after COVID in March of 2020, markets bounced back to all-time highs less than a year later. We were already at all-time highs again. Right? Crazy to believe, but that happened, right? So we as investors have forgotten that these type of things can happen, right? Major economies and stock markets can fall into these major retraction periods. Now, why am I bringing this all up? Imagine something like this happening to the US stock market. I'm not saying a 30-year retractionary period like the Japanese stock market, but let's just even say 10 years. 10 years. Imagine that happen, right? We as investors, we know the average investor doesn't like holding onto a stock any more than 5.5 months. Imagine being told to ride it out for 10 years. 10 years for things to turn around. Imagine 10 years of seeing your money in the red. 10 years. And we know that we as investors feel losses much more than we do gains. How would that make you feel? It's very easy to say, I would just ride it out. But would you really, right? What we know about behavioral economics is it suggests that you probably would not ride it out. It suggests that it would be incredibly uncomfortable and you would eventually deviate strategy at some point. And at that point, it may cause you to lock in pretty significant losses. So again, I'm not saying that the US stock market is going to fall into a 30-year retractionary period, but retractionary periods do happen, and we don't have to look too far to see evidence of that. If we look right after the dot-com bubble, the US stock market, and really all stocks, right, kind of fell into this retractionary period for several years, right? There was negative returns all the way from 2000, 2003, and then markets globally started to recover. But here's what's interesting. Even once markets started to recover, The US stock market really didn't do that hot from 2000 all the way to 2008 when the financial crisis happened. The US stock market lagged. It had years of negative growth, and then it had pretty subpar growth that didn't really make up a whole lot of ground. The end result was the average annual return from 2000 to 2007, when you look at the total US stock market, was about 3.5% annualized during that period of time. You look at international stocks on the other hand. International stocks during that same period, the return was around 8.5%. More than double the returns of the US stock market. That's significant. That's really significant. Because again, put yourself in this position. Imagine it's almost 8 years of very subpar growth with US stocks, and you're one of those people that looks at a 10-year look back chart like everybody else, right? When they look up a fund, they're like, well, what's the 10-year performance? If you looked at the 10-year performance of the US stock market during that period of time, it wouldn't be that hot. You'd see international stocks being real hot, and you'd see domestic doing poorly, right? And this isn't the only period of time where this happened, right? There are various decades throughout history where there's this flip-flop in leadership from US and international, et cetera. So let's make this even more real, right? If you had $100,000 invested in the US stock market from 2000 to 2008 during that time, your $100,000 turns into an around $127,000 investment. If you had all your money in international stocks during that period of time, your $100,000 investment turns into roughly $177,000. You darn near double your money during that period of time with international stocks. So again, is the point getting across here, right? International beat the baloney out of the US stock market during that period of time. But here's what I really want to reinforce here is I'm not saying swing trade and sell out of US stocks, right? I'm not saying abandon ship and put all your money in international or vice versa, right? I'm not saying that at all. But the point that I'm trying to get across here is there's a reason why the expression diversification is the only free lunch in investing, right? If you spread your chips out, that can help mitigate the risk of being wrong. So if we look, again, using 2000, 2007 as our kind of example period, if you were to spread out your chips, 60% US stocks, 40% international, your $100,000 investment would be worth $145,000, almost $146,000 during that period of time, right? So your returns are a lot better than somebody who just put all their money in US stocks. It's not as good as someone who put all their money in international stocks. But how realistic is that? Who's actually going to put all their money in international stocks, right? I mean, that would be risky to do. And it's maybe not entirely realistic. But that's why you spread out your chips this way, is because you don't want to risk being wrong. And that's the reality, guys. The reality is that, is it realistic that the US stock market falls into a 30-year retractionary period like Japan did? I wouldn't say it's realistic at all, but to say that it's impossible isn't realistic either, right? I mean, it could happen, right? The US stock market could fall into a significant retractionary period. History would suggest that at some point that will happen. I'm not saying a 30-year retractionary period, but at some point it will happen. But we don't know when that's going to happen. But what we do know is that by considering spreading out our chips, we can protect ourselves in the event that it happens. And so if you've ever wondered, do you need international stocks? The answer is you are free to do whatever you want. But I would strongly consider it because diversification is the only free lunch in investing. I hope you learned a thing or two from today's episode. If you need help analyzing your own portfolio, your own taxes, your own financial plan, whatever it is, reach out to us, www.modernwealth.com. That's modern spelled with no vowels, wealth.com. Hope you enjoyed it, guys. A lot of fun. We'll see you next time.